Hello, I'm Richard, and today I'm going to be discussing the definition of the tax base of an asset in terms of IAS 12. So, just to recoup, in terms of IAS 12, we need to match the future tax consequences to the future economic benefits that will be obtained from the asset. So, an asset, if I put the future economic benefits on a timeline, the carrying amount today is represented by future economic benefits. Those might be future operating profits on PPE, cash received on debtors, etc. Now, what we need to do from a principal perspective is those future economic benefits need to be matched with the future outflows or the future tax consequences. So, future profits, which are the future economic benefits, will have resulting future tax flows, and we result or recognize today a carrying amount of the tax consequences, usually in the form of deferred tax. So the point of today is to define what is that tax consequence or the tax base for underlying assets. So we have a standard to refer to. We look at IAS 12, paragraph 7, and very wordy, so I'm going to rush through this quickly and then break it down. The tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to the entity when it recovers the carrying amount of the asset. If those economic benefits, those future profits, future cash receipts, will not be tax deductible in the future, then the tax base is simplified as the carrying amount. Okay, breaking that down. Taking that definition and starting off with almost like a decision tree on how you get to the definition of the tax base for an asset. First, you must obviously identify what are the future economic benefits represented by the carrying amount of that asset. The next thing, are those future economic benefits taxable when they are realized? You'll see here we're going to have two examples we'll deal with shortly. Future economic benefits for an item of PPE, that will be future operating profits. So when I do my little pi sign like that, that means profit. For debtors, the future economic benefit will be cash receipts when your debtor pays you. Now, are those future economic benefits taxable when realized? For PPE, will future operating profits be taxable? Definitely, yes. For debtors, will those future cash receipts be taxable? No, because the tax authorities will generally tax you on the earlier of accrual or cash receipt. Well, when I invoice and raise the debtor, that's the accrual date. So as I raise the debtor and the related sale, then guess what? That's when SARS treats that as taxable income. He does not tax me again when the debtor pays me. So that would be definitely no to being taxable in the future. So let's look at those two scenarios. If it was yes, as is the case for PPE, well then the tax base will equal the future tax deductions. If it was no, then I'm going to say that the tax base equals the carrying amount, as we are told to treat it in terms of IAS 12. Practically, let's do two of those examples. So for PPE, I'm going to have a carrying amount. Let's do a little example. Carrying amount of 1,000. Let's assume that that has a capital allowance from the tax authorities. So the future tax deductions, let's say that the tax deductions were larger than the accounting depreciation, so I might only have 800 Rand left as future tax deductions. So please, the tax base of that asset here is equal to the future tax deductions, because the future economic benefits on the PPE will be taxable when realized. Therefore, I land up with a temporary difference of 200. Now understand, what do the underlying carrying amounts and tax bases represent? Carrying amount, future economic benefits. Tax base, future tax deductions. Therefore, this 200 Rand temporary difference is a taxable temporary difference, i.e. being future taxable income. I then need to work out deferred tax on the future taxable income. And let's say we're working on a flat rate of 30%. So therefore, deferred tax 200 times 30% gives me 60. And we can all understand that that future taxable temporary difference, future taxable income, will result in a future outflow to make payment of future tax. So then I'm going to have an obligation, a liability. Okay, so that's for PPE. Another example is debtors. So same figures. Carrying amount of debtors on the books of 1,000. Now I've got to ask myself, that 1,000 carrying amount, will that be taxable in the future when realized? No, it won't, because the tax authority has already included that 1,000 in our taxable income when we invoiced that debtor. So the tax base over here for this debtor will equal the carrying amount, not the future tax deductions, because there's not going to be any effect on the future taxable income, and therefore it's right that the temporary difference is 0 and the deferred tax is also 0. Now I hope that makes sense conceptually. I know we also all love rules. So what I'm going to do is just some rules for assets. On my little financial position calculation, carrying amount, tax base. If the carrying amount of an asset is bigger than the tax base of an asset, that means the temporary difference will be a taxable temporary difference, and the deferred tax will be a liability. Conversely, if the asset has a carrying amount that is smaller than the tax base, it's going to result in a future tax deduction, therefore a deductible temporary difference, and a resulting deferred tax asset. And that's conceptually sound. A future tax deduction is a future economic benefit, therefore it's an asset. I hope this has helped. Please watch the next video on the tax base of liabilities as well as the tax base of income received in advance. Thank you. Goodbye.